What's going on, everyone, and welcome back to the Investment Diary. Today, we're diving into some truly massive news that has the entire financial world buzzing. If you're even remotely interested in investing, this is a story you absolutely need to pay attention to. We're talking about none other than the Oracle of Omaha, Warren Buffett, and his Berkshire Hathaway making a significant new bet. That's right, folks. Berkshire Hathaway, the investment conglomerate led by the legendary Warren Buffett, has just revealed a brand new stake in the healthcare giant UnitedHealth Group. And this isn't just a small nibble. We're talking about approximately 5 million shares, translating to a roughly $1.6 billion investment. This disclosure, which came through Berkshire's latest 13F filing, sent shockwaves through the market, and for good reason. Buffett's moves are closely watched by investors of all levels, and this one is particularly intriguing. Now, the immediate reaction in the market was nothing short of dramatic. Major financial news outlets like Reuters and Barron's were all over this story the moment it broke. The sheer weight of Buffett's endorsement caused UnitedHealth's stock price to spike significantly. In fact, the shares of UnitedHealth experienced their biggest single-day pop in years. We're talking about a double-digit percentage increase on the day the news became public. This just goes to show the immense influence that Warren Buffett still holds and how his investment decisions can instantly impact a company's valuation. It makes you wonder, doesn't it? What does the man who has built one of the most successful investment track records of all time see in UnitedHealth Group right now? That's exactly what we're going to unpack for you today. Before we delve deeper into Buffett's potential reasoning, let's take a step back and ensure everyone understands exactly what UnitedHealth Group is. For those who might be newer to the world of finance or perhaps haven't followed the healthcare sector closely, this is a crucial foundation. At its core, UnitedHealth Group is the #1 health insurer in the United States. But it's much more than just an insurance company. It's a massive health services conglomerate with a truly significant reach across the entire healthcare landscape. The company operates primarily through two major pillars. The first, and perhaps most well-known to consumers, is UnitedHealthcare. This is their insurance arm, providing a wide range of health benefit plans to individuals, employers, and government entities. Think of it as the traditional insurance side of the business, covering medical expenses for millions of Americans. The second pillar, and arguably the one with the most significant growth potential and complexity, is Optum. Optum is a powerhouse in itself, encompassing a diverse range of health-related services. It's further divided into several key areas, including Optum Health, which focuses on direct patient care and physician services, Optum Insight, which leverages data analytics and technology to improve healthcare outcomes and efficiency, and Optum Rx, their pharmacy benefit management arm, handling prescription drug benefits for a vast number of people. To give you a sense of the sheer scale we're talking about, UnitedHealth Group serves approximately 148 million people. That's nearly half the population of the United States. This massive scale gives them unparalleled leverage across various aspects of the healthcare system, including payers, the insurance companies themselves, healthcare providers, doctors, hospitals, and clinics, pharmacy benefit managers who negotiate drug prices, and, as we mentioned, in the crucial areas of health data and information technology. This integrated approach is a key differentiator and a significant part of their competitive advantage. Now let's get back to the burning question. Why did Warren Buffett and Berkshire Hathaway decide to initiate such a significant position in UnitedHealth Group? While we can't know for sure what goes on in the minds of Buffett and his team, we can analyze the situation based on his well-known investment principles and the current state of UnitedHealth Group. This move certainly has the hallmarks of a classic Buffett play. He has a long history of investing in high-quality franchises, businesses with strong competitive advantages, often referred to as economic moats, and it appears he believes that UnitedHealth Group, despite some recent challenges, fits this description. The fact that they are the #1 player in a critical and growing industry like healthcare certainly strengthens this argument. Another key aspect of Buffett's strategy is to look for opportunities where a fundamentally sound business has been temporarily impacted by headwinds, leading to a more attractive valuation. This seems to be precisely what he saw in UnitedHealth Group. As we'll discuss later, the company has faced some significant challenges recently, which have put downward pressure on its stock price. Buffett likely views these as temporary issues that the company will overcome. It's also interesting to note the timeline. Berkshire built this significant position under confidential treatment, meaning they were allowed to keep their purchases private for a period to avoid unduly influencing the stock price as they accumulated shares. The investment was only revealed in their 13F filing for the second quarter of 2025, which provides a snapshot of their holdings as of the end of that quarter. This secrecy during the accumulation phase is a tactic Buffett has used in the past when building large stakes. Furthermore, the valuation of UnitedHealth Group at the time Buffett was likely buying was quite compelling. The stock was trading at around 16 to 17 times its projected forward earnings. This is not only below its own 5-year average price-to-earnings ratio, but also below the average P/E ratio of the broader S&P 500 index. This suggests that Buffett saw an opportunity to buy a leading company at a reasonable, if not attractive, price. Finally, let's not forget the dividend. UnitedHealth Group also offers a dividend yield of approximately 3% or higher. While Buffett is not exclusively a dividend investor, a healthy and growing dividend from a fundamentally strong company certainly adds to the overall investment appeal. It provides a steady stream of income while waiting for the company's stock price to appreciate. So, putting it all together, it appears Buffett identified a high-quality business in a crucial sector facing temporary challenges that had depressed its valuation to an attractive level, all while generating strong cash flow and paying a decent dividend. This fits his investment philosophy like a glove. The market's reaction to the Buffett news was immediate and significant, as we touched on earlier. Let's delve a bit deeper into the market impact and the setup that preceded Buffett's investment. As a reminder, the stock price of UnitedHealth Group jumped by a significant 11 to 14% on the day Berkshire's stake was disclosed. This immediate surge highlights the market's confidence in Buffett's judgment and the potential for a reversal of the stock's prior downward trend. However, it's crucial to keep this jump in perspective. Even after this substantial increase, the UnitedHealth stock price was still below its average trading price from the second quarter of 2025, suggesting that there might still be room for further appreciation if Buffett's thesis proves correct. What's particularly interesting is the context leading up to Buffett's investment. Over the preceding year, UnitedHealth's shares had actually fallen quite dramatically, in the range of 40 to 50% year over year. This significant decline was driven by a confluence of factors that had been weighing heavily on the stock. These included rising medical cost inflation, which put pressure on their insurance margins, increased scrutiny from regulatory bodies, including various probes into their business practices, and even some leadership turmoil, which can create uncertainty for investors. It's quite possible that these very headwinds, which caused many investors to sell or avoid UnitedHealth Group, are precisely what created the opportunity that Warren Buffett and his team recognized. He often says to be greedy when others are fearful, and this situation certainly seems to align with that philosophy. The significant drop in share price likely presented a much more attractive entry point for a long-term investor like Buffett. It's always insightful to see what other prominent investors, the so-called super investors, are doing. Interestingly, Berkshire Hathaway wasn't the only notable fund that initiated a position in UnitedHealth Group during the second quarter. According to their respective 13F filings, Michael Burry of Scion Asset Management, known for his prescient bet against the housing market in 2008, and David Tepper of Appaloosa Management, another highly respected hedge fund manager, also disclosed new purchases of UnitedHealth shares in the second quarter. This suggests that Buffett wasn't alone in seeing value in the company at its recent price levels. Furthermore, data compiled by Datarama, a website that tracks the holdings of prominent investors, shows a broader trend of increasing super investor ownership in UnitedHealth Group. They reported that the number of super investors holding UNH stock rose to 19, with a particularly significant addition to the position held by Christopher Davis of Davis Advisors, a well-regarded value investing firm. The fact that multiple highly successful and discerning investors, each with their own unique investment strategies, have all recently initiated or added to positions in UnitedHealth Group provides further validation for the idea that the company may indeed be undervalued and poised for a potential recovery. It's always a good sign when the smart money starts moving in the same direction as the Oracle of Omaha. To get a better understanding of the underlying health of the business and its future prospects, let's take a closer look at UnitedHealth Group's latest fundamental performance and their outlook for the remainder of the year. In their second quarter earnings report for 2025, UnitedHealth Group announced an adjusted earnings per share of $4.08. While this figure in isolation doesn't tell the whole story, it's important to consider it in the context of their overall financial picture and future guidance. Looking ahead, they provided a revenue outlook for the full fiscal year 2025 in the range of $445.5 billion to $448.5 billion. This demonstrates the sheer magnitude of their business operations and the significant revenue they continue to generate. More importantly, perhaps, is their revised outlook for adjusted earnings per share for the full year 2025. They have set a target of at least $16. Now, this figure is particularly noteworthy because it represents a significant reset from their prior guidance. This downward revision in expectations was one of the factors that contributed to the earlier decline in the company's stock price. Financial analysts often describe a situation where a company significantly lowers its guidance as a kitchen sink year. This is the idea that management is taking the opportunity to account for as many potential negative factors as possible in one reporting period, effectively clearing the deck for potentially stronger performance in the future. The fact that UnitedHealth Group significantly reset its EPS outlook suggests that they are acknowledging the current challenges and setting a potentially more achievable benchmark for future growth. It's also important to remember that even with this reset in guidance, UnitedHealth Group is still projecting to generate substantial revenue and earnings. This underscores the underlying strength and resilience of their core businesses. We should also keep an eye on their cash generation figures in future reports, as strong cash flow is a hallmark of a healthy and sustainable business, and a key metric that Warren Buffett closely analyzes. So, while the revised outlook reflects the current headwinds, it also potentially sets the stage for future positive surprises if the company can effectively manage these challenges and return to its previous growth trajectory. This leads us to consider the potential upside drivers for UnitedHealth Group. Despite the recent challenges and the downward revision in guidance, there are several compelling reasons to believe that UnitedHealth Group could still be a successful investment over the long term. Firstly, as we discussed earlier, their sheer scale provides significant economic advantages. This allows them to negotiate better prices with healthcare providers and suppliers, operate more efficiently, and invest heavily in technology and innovation. Secondly, their vertical integration across the healthcare value chain, encompassing payers, UnitedHealthcare, pharmacy benefit management, Optum Rx, care delivery, Optum Health, and data analytics, Optum Insight, creates powerful synergies. This allows them to control costs, improve care coordination, and gain valuable insights into patient health, ultimately leading to better outcomes and potentially higher profitability. Looking at broader macroeconomic trends, the aging demographics in many developed countries, particularly in the United States, are expected to drive increased demand for healthcare services in the years to come. This provides a significant tailwind for companies like UnitedHealth Group. Furthermore, the ongoing shift in the healthcare industry towards value-based care models, where providers are incentivized based on patient outcomes rather than the volume of services they provide, aligns well with UnitedHealth's integrated approach and their capabilities in data analytics and care coordination. Analysts who cover the company also frequently cite their increasing focus on operational efficiency, leveraging technologies like artificial intelligence and advanced data analytics to streamline processes, reduce administrative costs, and improve the quality of care. These technological investments have the potential to drive significant long-term cost savings and enhance their competitive edge. Finally, despite the recent stock price decline and the challenges the company faces, the consensus among Wall Street analysts who cover UnitedHealth Group still leans towards a buy rating. While price targets vary across different sources, the average target price often implies a potential upside of around 20% or more from the current trading levels. This suggests that despite the risks, many analysts believe the company is undervalued and has significant potential for future appreciation. Of course, it's crucial to remember that analyst ratings and price targets are just opinions and should not be taken as guarantees. However, the generally positive sentiment from the analyst community, coupled with Buffett's investment, provides further support for the potential upside in UnitedHealth Group. Now, before you rush out and buy shares of UnitedHealth Group solely based on Buffett's investment and the potential upside, it's absolutely critical to understand the risks involved. Every investment carries some level of risk, and UnitedHealth Group is no exception. One of the most significant risks facing UnitedHealth Group and the broader healthcare industry is the regulatory and legal landscape. The company is currently subject to various investigations by the Department of Justice, including scrutiny of their Medicare practices. Furthermore, pharmacy benefit managers, like their own Optum Rx, are under increasing pressure from regulators and lawmakers due to concerns about drug pricing and transparency. Any adverse findings or new regulations could have a significant negative impact on their business and profitability. Another major risk factor that has already had a tangible impact is cybersecurity. The recent cyber attack on Change Healthcare, a subsidiary of UnitedHealth Group, was a significant event, affecting an estimated 192.7 million individuals. The fallout from this attack has been substantial, including significant financial costs related to recovery efforts, potential fines, and reputational damage. The healthcare industry is a prime target for cyber attacks due to the sensitive nature of patient data, and this incident underscores the ongoing vulnerability and the potential for future disruptions and costs. Additionally, the trend of rising medical costs remains a significant concern for all health insurers, including UnitedHealth Group. Elevated medical cost trends can squeeze their profit margins and lead to further guidance resets, as we've already seen this year. The ability of the company to effectively manage these costs will be crucial for their future profitability. Finally, the recent leadership changes within the company, including the swap of the CEO position that saw Stephen Hemsley return to the helm, introduce an element of uncertainty. While Hemsley has a long and successful track record with UnitedHealth Group, any significant changes in leadership can create instability and impact the company's strategic direction. It's essential for any potential investor to carefully consider these risks and weigh them against the potential upside before making any investment decisions. The healthcare industry is complex and constantly evolving, and these risks highlight the importance of thorough due diligence. Now let's try to get a better handle on what UnitedHealth Group might actually be worth. Determining the fair value of a company is not an exact science, but looking at various valuation metrics and expert opinions can provide some valuable insights. Morningstar, a well-respected investment research firm, recently provided a fair value estimate for UnitedHealth Group of around $400 per share. It's worth noting that this is a reduction from their earlier estimate of $473, likely reflecting some of the challenges the company has faced. However, even at $400, if we compare this to the current trading range of approximately $270 to $310, it suggests a significant potential upside if the company can improve its execution and navigate the current headwinds successfully. We also looked at analyst price targets, and as we mentioned earlier, they tend to cluster in the range of $306 to $330 for the next 12 months. However, it's important to remember that there's a wide range of individual analyst price targets, spanning from a low of around $198 all the way up to a high of $418. This wide dispersion highlights the uncertainty and varying opinions among market professionals regarding the company's future prospects. Interestingly, if we look at independent valuation models, such as those created by the online investment community using discounted cash flow analysis, the base case fair value estimates often center around the $360 to $375 range. Now, it's crucial to understand that these are illustrative and based on individual assumptions, so they should be taken with a grain of salt. However, they provide another data point suggesting potential undervalue at current levels. Overall, the valuation picture for UnitedHealth Group suggests that there might be a significant disconnect between its current market price and its intrinsic value, as estimated by various analysts and models. This potential undervalue is likely a key reason why value investors like Warren Buffett have found the stock appealing. So, after analyzing all of this information, Buffett's investment, the company's fundamentals, the market impact, the potential upside drivers, the risks, and the valuation, what should investors actually do now? Let's get into our investor playbook for UnitedHealth Group. Our investment thesis here rests on several key points. UnitedHealth Group is a high-quality platform with a leading position in a crucial industry. It's currently facing some temporary pain and headwinds that have depressed its stock price. However, it has credible and experienced operators at the helm, and it now has the strong endorsement of Warren Buffett and Berkshire Hathaway. Given this thesis, our plan for approaching a potential investment in UnitedHealth Group involves careful consideration. Finally, when considering position sizing, it's essential to respect the current uncertainty surrounding the company. Implement appropriate risk management rules, such as limiting the maximum percentage of your overall portfolio allocated to a single stock. You might also consider using optional stop-loss orders to limit potential downside risk, although this is a personal preference and depends on your individual investment strategy and risk tolerance. Ultimately, Warren Buffett's investment in UnitedHealth Group is a significant vote of confidence in the company's long-term prospects. However, as always, it's crucial to conduct your own thorough research, understand the risks involved, and make investment decisions that align with your individual financial goals and risk tolerance. Don't just blindly follow any investor, even one as successful as Warren Buffett. That's all for today's deep dive into Warren Buffett's new investment in UnitedHealth Group. We hope you found this analysis helpful. If you did, please remember to like this video, subscribe to the Investment Diary for more in-depth investment analysis, and leave your thoughts and questions in the comments section below. We always love hearing from you. Thanks for tuning in, and we'll see you in the next video.